Okay, so this next video lecture is still for our Module 3 Ethics, Fraud and Internal Control. So we are now in the second topic, which is fraud and accountants. So we have here the legal definition of what fraud is. But before we define fraud, let us talk about its existence, okay, and its effect on an enterprise. So of course, when there is fraud, or actually fraud is normally existing in all organizations, especially if there are people within the entity which has their own personal interest and they override the activity, the reports, the representation, and others to satisfy their needs and to meet their objectives. Okay, so basically fraud has a negative effect on the entity, okay, which causes it up to the extent of losing. Okay, so here in most cases also in some cases there are fraud in which accountants are involved. Okay, because since our role in an organization is to provide financial information which are normally used for economic and sound decision making of the users. So basically, accountants are used, okay, so that the representation in the form of financial reports will be controlled and even manipulated. Okay, so we have here the definition or the legal definition of what fraud is. So when we say fraud, this denotes a false representation of a material fact that is made by one party to another party with the intent to deceive and induce the other party to justifiable rely on the fact to his or her detriment. So what do this means actually when we say fraud? So we will talk about the elements from the definition given. So we have here the first element of fraud is there is false representation. When we say false representation, this is a false statement or disclosure, meaning this is an incorrect presentation of financial or other data. These are manipulated result, okay, or report, because those person who did this fraud has personal interest or financial interest why they do it. Okay, so again, there is false representation. Another is this false representation is related to a material fact. Actually, what they falsify here is a material fact. So what do we mean when we say material fact? This is a fact that must be substantial in inducing someone to act. When we say material fact, this simply means that this is an information, a data, which can influence the decision of the users. So when they see or when they rely on this material fact, it will draw them in deciding, okay, for a certain option or alternative or decision. Okay, so that's why in this case, those who did this fraud will falsify this material fact to induce those users or decision makers in deciding what to do, which is in accordance to their personal interest. Okay, another element of the definition of fraud is it has to be intentional, okay, to deceive the other party. When we say intentional, this means that it is known by the person who did this that this is wrong, this is false, but they do it anyway because again, they have objectives to meet. Okay, so there is intention to deceive the other party. Another is there is misrepresentation. Okay, and the result of this misrepresentation is to the other party to justifiable rely upon those information. Okay, so again, this is related to those falsified material facts. So because of that, the other party have decided otherwise. Okay, if they only knew the real picture of the status, for example, financial status of the entity, then they would have decided the other way. But because this is what was represented to them, so this is what they choose. Okay, and lastly is that this misrepresentation have caused either an injury or loss to the other party. Okay, so in this case, because they relied on a falsified data, so it will result into financial losses, okay, later on. So this is the elements of the legal definition of fraud. So in our illustration right here, we have here the fraud triangle. So if you could notice, the arrow downward, or this two arrow downward, is the pressure and opportunity. Meaning, if there is pressure, so fraud might be one of the options in order for example, a pressure to meet a target. So in order to meet this target, so they might resolve into acting fraudulently because they have no other means, or they have no other choice, or actually they have the choice but they choose to do unethically, okay, because of the pressure. Another is opportunity. When there is an opportunity to conduct or to do fraudulent acts, then someone might actually do it anyway. Okay, so these are the two important factors that results into fraud or misconduct. But because of ethics, so the arrow upward, so this is the one who balances, which balances, okay, this pressure and opportunity in committing fraud. So if you could notice, if ethics is very high, so most probably there is no fraud. But if ethics is too low, then fraud will exist naturally. Okay, so this is how it is in an organization. So in business, fraud is an intentional deception or a misappropriation of a company's assets or manipulation of its financial data to the advantage of the perpetrator. Okay, so this is in the case of business. So we have here the data that shows. Okay, so this is in 2008, a study of fraud conducted by the Association of Certified Fraud Examiners. So in this research or study, they found out, okay, the percentage of fraud and its equivalent loss in dollars. So this is the loss due to fraud equal to 7% of revenues. So approximately that's $994 billion. So that's a great amount. Okay, so loss by position within the company. So in this case, fraud committed by the owner or executive manager that accounts, for owner or executive in management. So basically, this is 20%, based on that study in 2008. So its equivalent loss is $834,000. While those fraud committed by the managers, this accounts for 37%, which is equal to $150,000. And the employee who committed fraud. So if you could notice in the data, it accounts for 40%. So from among all the other or all of the positions in an entity, so there are more employees who are committing fraud. So this however, if it will be accounted for its equivalent um, in in value or money, so this is only $70,000. Actually, there are a lot of employees probably who committed fraud, but this is in small amount compared to the owner or the executive. So there are smaller percentage of those owner or executives who are committing fraud, but it accounts for greater amount of loss. Okay, so this is how they found out. So other results, higher losses due to men, employees acting in collusion, and employees with advanced degrees. Okay, so meaning there is really fraud that exists. Okay, so simply because there is opportunity or pressure on this personnel, even the owner. Okay, what about Enron, WorldCom, Adelphia underlying problems? So these are actually ethical dilemmas that was faced by the accountant or even the auditors, external auditors. So here in this illustration or example, this is where accountants are actually involved in fraud or fraudulent actions. So all of this, Enron, WorldCom, Adelphia. So here, these are some of the key points, okay, that were emphasized. Okay, so in these cases, there is lack of auditor independence. Auditing firms also engage by their clients to perform non-accounting activities. So again, the auditors, the accountants were actually engaged, okay, into non-accounting activities because of their non-independent of lack of independence on their part. So they were influenced by their clients. Another is, in these cases also, there is lack of director independence. So directors who also serve on the boards of other companies, have a business trading relationship, have a financial relationship as stockholders, or have received personal loans, or have an operational relationship as employees. So in this case, there are a lot of roles that the directors are having, even those incompatible roles. Okay, so that's why it resulted into fraud later on. Another is, there is questionable executive compensation scheme. So short-term stock option as compensation. This results in short-term strategies aimed at driving up stock prices at the expense of the firm's long-term health. So again, this questionable executive compensation schemes, this is maybe done, okay, because of the personal and financial interests of those executive personnel. Okay, so they want to gain more than what is equitable for them to receive from the entity. So it resulted into fraud. Okay, another is, in these cases also, there is inappropriate accounting practices present. So this is a characteristic common to many financial statement fraud schemes. So again, it definitely is a fraud. Another is, Enron made elaborate use of special purpose entities. Okay, so they deceive or they use other entities, okay, to satisfy their interest and to meet their financial objective. Another is WorldCom transferred transmission line cost from current expense account to capital account. So again, this is inappropriate accounting practices. Okay, so it resulted into fraud. So because of these problems or fraud that or which involves the accountant or the external auditors. So the Sarbanes-Oxley Act of 2002 was established. So actually, Sarbanes-Oxley Act is this is an act to protect investors by improving the accuracy and reliability of corporate disclosures made pursuant to the securities laws and for other purposes. Okay, so its principal reforms pertains to the creation of the Public Company Accounting Oversight Board or PCAOB, auditor independence. So meaning to say there should be more separation between a firm's attestation and non-auditing activities, okay, in order to preserve the independence of the auditors. Another is corporate governance and responsibility. So here, audit committee members must be independent, and the audit committee must also oversee the external auditors. Another is disclosure requirements. So here, there should be an increased and management disclosure. Okay, so that any fraud or fraud that exists there may be detected. Another is new federal crimes for the destruction or tampering with documents, securities, fraud, and actions against whistleblowers. So again, this is to help those employee within an entity to voice out whatever they know which relates to any fraudulent activities that is going on in the entity. Okay, so this is the answer to this ethical dilemma with these cases right here. Okay, so we've been talking about fraud earlier. So basically, there are two main types of fraud in an organization. So we have employee fraud and management fraud. So here, when we say employee fraud, this is committed by non-managerial personnel. So usually, this consists of an employee, example, taking cash or other assets for their personal gain, or they circumvent a company system of internal control to gain access for their personal interest, and so on. Again, this is committed by the employee or non-management personnel. While management fraud, on the other hand, this is perpetrated at levels of management above the one to which internal control structure relates. So frequently, this involves using financial statements to create an illusion that an entity is more healthy and prosperous than it actually is. Okay, so the purpose of this is to gain more fund from the investors. So this involves also misappropriation of assets and frequently is shrouded in a maze of complex business transaction. The purpose of this is to hide those fraudulent acts that they have committed. Okay, but if you are going to audit it or check on its accuracy, for example, then you might uncover that fraud actually exists. Okay, so those are the two types of fraud. So what are the common fraud schemes that is present in a business entity? So basically, we have three categories of fraud schemes according to the Association of Certified Fraud Examiners. So we have first, fraudulent statements. So in this case, the perpetrators are misstating the financial statements to make the copy appear better than it is, or to make their financial status appear that they are healthy or prosperous when in fact they are losing. Usually, this occurs as management fraud, okay, and may be tied to focus on their short-term financial measures for success. And it may also be related to management bonus packages being tied to financial statements. So because there is pressure and of course to meet their financial target. So they do fraudulent statements. Another fraud scheme that is very common also is corruption. So examples, bribery, illegal gratuities, conflict of interest, economic extortion. So foreign corrupt Practice Act of 1977 is indicative of corruption in business world, impacted accounting by requiring accurate records and internal controls to avoid corruption. Okay, or to minimize corruption. Actually, you cannot eradicate or totally eliminate it, but you can just lessen or avoid it as much as possible. Okay. And the third most common fraud scheme is asset misappropriation. So this is the most common type of fraud and is often occurs as employee fraud. So what are the examples of asset misappropriation? These are making charges to expense accounts to cover theft of asset, especially cash, because this is susceptible to theft. Lapping, using customers' check from one account to cover theft from the different account. This is lapping. Transaction of fraud, deleting, altering, or adding false transaction to steal assets. Okay, so these are the examples of how asset misappropriation are being conducted by an employee. Okay, so basically in these three fraud schemes, corruption and fraudulent misstatement are normally on the top management level, while asset misappropriation is an employee fraud. Okay, so those are the fraud and those actions or fraudulent actions which involves the accountants.